For 30 years, Japan has been the financing center for rest of the world. Its interest rates have been close to zero, so investors have borrowed in yen and bought assets worldwide. This carry trade, Japanese carry trade, has quietly fueled the global stock markets. But now you must be seeing that the Japanese bond yields are surging and that the 30-year machine is reversing. Japan's 40-year bond yield has jumped from 1.5% to 3.4% in just 2 years, its fastest surge in decades. When Japan's money starts flowing back home, the rest of the world's financial system definitely gets an impact. Because when the Japanese bonds start offering higher returns, then the Japanese investors no longer need to chase US or European assets for income. So they start selling the US treasuries, the European government bonds, and even the Asian equities and put the money back into Japan. This triggers a stronger yen, a weak dollar, and a potential bond market quake across the continents. This is not a Japanese problem anymore. It's a global liquidity shift from the west to the east. The yen avalanche phenomenon, as it is popularly called. Historically, every time Japan tightens its liquidity, there has been a problem. 1998, you had the Asian financial crisis, deepened as the yen surged. In 2008, the carry trade unwound, accelerating the global meltdown. 23 to 25 similar patterns are re-emerging quietly but faster. Be careful. In 2020, Japan held over $1.2 trillion in US treasuries, the largest foreign holder. Now, even if 10% of this is repatriated back home to Japan, it could flood the US markets with unwanted bonds. Already there is a budget deficit and Donald Trump is trying hard to fill it. Now there will be a bigger deficit. So the reaction which is there can cause havoc and needs to be kept on everyone's radar. Everybody is looking at the US inflation or the Chinese real estate, but the real tremor is building under Tokyo. Japanese government debt is over 260% of its GDP, the highest in the world. Even a small rise in the bond market yields makes the debt servicing brutally expensive. So the Bank of Japan faces a choice. Either print more yen and risk inflation, or stop printing and risk a bond market collapse. Either way, the outcome rhymes not very good for the market. In the late 70s, Japan faced a similar pivot when the global rates spiked. But history does not repeat. It whispers and it sounds very familiar. This isn't just about Japan. It's a signal that the era of the cheap global money is ending. Now, Federal Reserve in the United States under a lot of pressure to reduce interest rates. But they have to realize that they are in an era where the bond yields are moving up in Japan. Money is flowing back to Japan. So they need to have some incentive for the investors to buy the US treasuries as well. If they keep falling in yields, they will not come to America. It's a complex situation, friends. The Japanese unwinding of its carry trade has historically not been very good for the markets. Keep an eye on the Japanese bond yield to get to know more when this can actually come to the inflection point and cause harm to the world. Do join our premium value. For the Indian markets, you get 1 week predictions and events. And for the US markets, you can join the Prime Plus. Gives you 1 week US market predictions for both. Number to get in touch, 9820861044. Or you can alternatively also WhatsApp us, 732-732-2720. Happy investing. Take care. Bye-bye.